Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar shows no signs of giving up. Stock indices are running away from tech, gold is approaching record highs, and Bitcoin is reminiscent of crypto winter. Christopher Waller's comments had as much of an impact on the US dollar as the US labor market statistics. The rise in unemployment to 4.6% and the acceleration in average private sector employment over 3 months from 13,000 in the summer to 75,000 in the autumn caused investors to change their views. They began to expect a prolonged pause in the easing cycle and a reduction in the federal funds rate to 3.75% in 2026. However, a senior FOMC official thinks differently. Christopher Waller is one of the candidates for the position of Fed chairman. He believes that the neutral rate is 2.75%, which is 100 basis points below current levels. This is significantly lower than the forecasts of the futures market. If the cost of borrowing falls to this level, Treasury yields will decline and the USD index will collapse. In addition, the futures market is confident that the ECB's monetary easing cycle is coming to an end. Investors are beginning to price in expectations of a rise in deposit rates. This is usually done when the risks of inflation accelerating increase or monetary policy becomes too loose. Neither of these conditions applies to the Eurozone. It is too early to talk about a new trump card for Euro USD. On the contrary, weak data on business activity in the currency bloc and German business confidence from the IFO are disappointing ECB hawks and putting pressure on the euro. The regional currency appears too expensive. Rotation continues in the US stock market. According to a Bank of America survey, asset managers' optimism is at its highest level since July 2021. And the share of technology stocks is at its highest since the summer of 2024. Excessive excitement ends badly. Doubts about the return on huge investments in artificial intelligence are forcing investors to sell big tech and buy small cap companies. As a result, the S&P 500 is falling back. The Nasdaq Composite is falling even faster. Wall Street analysts expect corporate earnings to grow by 8.3% in the fourth quarter and to $310 per share by the end of 2026. This means that next year, the indicator will increase by 13%. It will then continue to grow in 2027. Such forecasts are bullish for the S&P 500 in the long term. However, at the end of 2025, traders want to invest in companies that generate sufficient returns on investment. The pause in the Fed's monetary expansion cycle until March deprives the index of its safety net. The bulls can only hope for a Christmas rally. There is a view in the market that long-term investors leave during this period of the year. What remains are speculators who act too emotionally. This leads to sharp rises or falls in the broad stock index. Gold has stalled just shy of historic highs. However, neither the rise in U.S. unemployment to a 4-year high, Christopher Waller's dovish rhetoric, nor the increase in geopolitical risks due to the U.S. blocking Venezuelan tankers under sanctions helped gold to break its record. Nevertheless, the forecasts of major banks are full of optimism. Goldman Sachs expects to see the precious metal at $4,900 per ounce in 2026, thanks to central banks' insatiable appetite for bullion. Their monthly purchases could reach 70 tons. BNP Paribas predicts a price of $5,000. This is linked to a slowdown in the global economy, accelerating inflation, and a collapse in the U.S. stock market. At the same time, a prolonged pause in the Fed's monetary easing cycle could lead to a temporary strengthening of the U.S. dollar and an increase in Treasury yields. This backdrop is considered unfavorable for gold, as is the potential end of the armed conflict in Ukraine. The current decline in Bitcoin is difficult to compare with the crypto winter of 2021 to 2022. At that time, Bitcoin lost about 80% of its value. Currently, losses amount to about 30% of the record highs recorded in October. Nevertheless, the growth in token supply amid sluggish demand is causing justified concern among cryptocurrency enthusiasts. According to K33 research estimates, the total number of Bitcoins that have been inactive for at least 2 years has decreased by 1.6 million coins since 2023. This amounts to $140 billion. CryptoQuant claims that over the past month, the volume of previously dormant tokens entering circulation has been the highest in the last 5 years. While in previous years this supply was absorbed by ETF enthusiasts and crypto treasuries, this is not the case in 2025. capital flows into specialized exchange-traded funds are negative, and strategy and its counterparts are facing serious problems. The main event of the week leading up to the 26th of December will be the release of U.S. GDP data for the third quarter. Bloomberg experts predict that the U.S. economy will slow down from 3.8% to 3.2%. The leading indicator from the Federal Reserve Bank of Atlanta gives a figure of 3.5%. High GDP growth rates supported the dollar in the second half of the year. After the White House introduced the most extensive tariffs since the 1930s, the U.S. economy was expected to cool significantly. Investors believed that import duties would be absorbed by U.S. companies and households. In fact, the economy proved to be resilient. This is thanks to the rally in stock indices and investments in artificial intelligence technologies. The growth of the S&P 500 increased the wealth of Americans and consumer spending. AI contributed to increased productivity. The stability of the U.S. economy is an important factor supporting the dollar. If the greenback loses this support, the Fed will have more reason to cut rates. This will have a negative impact on the USD index. Follow the updates on global markets in ProNews Weekly. Like, share, and subscribe.